Here we're coming down to our last installments on Chapter 14, and one of the things we need to take a look at is the Fed and the future, because it's probably leading to deflation. Normally, I don't talk about this subject because it's really not something that happens all that often. The last time it happened, you'd have to go back to like 2008. We had a market crash, and really we might still be in that same market crash now, where we've just sort of delayed the results of that sort of situation. You can go back to the stagflation of the 70s. You could go back from there to 1929, and the Great Depression is really what we're on the cusp of right now. And so we have to talk about these things so that we understand how this works. Okay? So first off, the Federal Reserve has a dual mandate. That's how they were set up by law. The first one was price stability, and the second one was low unemployment. Because at the time, especially in the teens and 20s, what happened is that economists came up with this theory right here. If you get into more advanced economics, it's called the Phillips curve, and it's a lot more complicated, but the basic essence of it is this. That inflation and unemployment are like teeter-totters. And so if you print a bunch of money, then you will get lower unemployment, but you will get higher inflation, okay? So inflation would go up and unemployment would go down if you print money, because with all that extra money, there'd be more money circulating and creating more jobs. Then if inflation got too high, you could always reduce it by not printing money, but that would lead to higher unemployment. So it would tilt this way on the teeter-totter or that way depending on your policies. So what the Fed has always tried to do is they've imagined that unemployment needs to be around 4%, and then inflation in that case would have to be 2%. Okay, so they always have this 2% inflation target. Well, that doesn't lead to price stability. That means that over time, your dollar loses most of its purchasing power in 100 years. That's what 2% inflation will do to you, okay? So they're really not meeting their first mandate of price stability. That would be like the gold standard, okay? And because they've tried to do that, they've just said, we'll just let the economy run a little hot and we'll keep everyone in a job and that'll make everyone happy. So we've always had this sort of tilted like that. The problem was that it doesn't work. Okay, and so due to other factors in the 50s and early 60s, it made economists think that it worked because after World War II, all the rest of the world was destroyed and America wasn't. And so everyone was buying things from America. And so our manufacturing was going and it was great. And unemployment was very low. And so, hey, our policies must be working. We're amazing. And then came the late 60s, okay, as the rest of the world rebuilt and retooled and started competing with America, our jobs began to offshore. And what happened is to keep things in their place, to keep that low unemployment, the Fed printed lots and lots of dollars. Well, strange thing happened. We had something called stagflation in the 70s, and so the teeter-totter broke. In fact, it broke upwards because we had high inflation and we had high unemployment at the same time, which according to the model cannot happen. You cannot have both sides of the teeter-totter go up in the air at the same time. And so a lot of them were left scratching their heads. Since that time, they really have not changed anything much. They've still been working with this Phillips curve, and they just sort of shrugged and said, well, it's the best we've got, and so we're just going to keep doing what we've been doing. And so what has happened is these people that run the Fed, they're central planners. They want to be able to manage the economy in such a way that they're pushing the buttons, pulling the levers, making everything work. They're known as central planners. And so they didn't know what else to do, so they just kept on printing money. Okay? So Other forces would move the market in other ways, and if it worked, then they would attribute it to themselves, and if it didn't work, they would attribute it to something else. And since the 70s, for about 30, 40 years, they've been sort of playing that game. The problem is that by doing this for such a long time, it is causing major dislocations in the economy, like dislocating your shoulder. It's causing money to flow into places where it probably shouldn't go. It's causing what's called in economics malinvestment, so that you're actually spending money on something that's going to cost you in the long run. It doesn't make sense to put your money there, but because of the endless money printing, people say, well, I got to put it somewhere, and off it goes in that direction. So what we've had since then is some major issues. We had the flash crash of 1987, where the market climbed and climbed and then dropped 30% in one day. It then ramped up again because we're just printing money, and in 2001 we had this tremendous high called the tech bubble, and it burst, and down it came. Okay? And then all that extra money flowed into real estate, and we had the great real estate bubble of 2007, and then boom, it went bust in 2008 and everything crashed. And then from there we've been running it up again. Okay. And we're at its all-time high. So hopefully you understand the pattern here is that when this model doesn't work anymore, what we get are increasingly higher booms and busts, so that each bubble is bigger than the last time, and each bust is bigger than the last time, and it just keeps getting bigger and exploding and bigger and exploding. And so where are we right now? It turns out the stock market is at the highest valuation level in history ever. Okay, that is adjusted for inflation, that is against real GDP. This is the highest the stock market has been. It is the most overpriced of any stock market in the history of America. All right, by any measure, this is the most expensive stock market. So if we're at our all-time high in real terms, the odds of us going even further are very slim. The odds of us going down are very great. So keep that in mind. At the same time, the real estate prices are higher than they were in 2007 in real terms. Okay, so you can measure that with a CAPE is one of the things that was developed by Robert Shiller, is the name of the economist from Yale who won the Nobel Prize for measuring this. And so if you want to look that up, CAPE, C-A-P-E ratio, the CAPE ratio measures this, and it is higher than it's ever been in the history of America. So here we are in late 2020 while I'm doing this video, and we're at the highest highs we've ever had in history. The odds are not looking good. And the problem is that what's pumping up all of these tremendous highs is the ever-increasing amounts of money being printed by the Fed, because they don't know what else to do. That they can manage things in certain ways, but they don't understand that maybe what they're doing is the problem. Maybe the problem is not external to them, maybe they are the problem. And even if they were to admit that, they would still keep doing what they're doing, because there is something known as the Cantillon effect. And if you want to Google that, you should. The Cantillon effect says that those who spend the printed money into the economy first get the benefits. So the closer you are to the fire hose of money coming out from the Fed, the more you benefit. So the person way at the end, they don't benefit at all. But the person or entities right at the front, when that money first comes out, they benefit the most. And who is that? Those are the elites of our country. Those are the big banks. Those are the major corporations. Okay? So they're friends at the Fed. If they keep printing that money into the economy, for example, if a big bank gets, $1 million, $1 trillion, whatever it is, I'm just going to use 1,000 here. If they get that 1,000, they go out and buy stocks, real estate, all the kinds of real goods. So they buy the stocks with the $1,000 that they got from the Fed. Now the prices go up on stocks for everyone else, and that's the inflation. So your price is the very high stock market prices that were purchased by the banks with money at the beginning, and so they got in at the low price, and by spending that free money in, it causes inflation. The stocks take off, and now they've basically made money, so to speak. They've achieved a higher value or a higher price for the real goods. What does that do to the common person, though? It means that a house that cost $100,000 20 years ago now costs $300,000 today. I know this because those are the houses I bought. All right? So 20 years ago they were $100,000. Now they're $300,000 because the people who bought the real goods early, especially with the free-ish money from the Fed that was created out of thin air, they then get the appreciation in price level. It accrues to themselves, while the common person has to buy the inflated price if they want to get it at all. So what is this doing? The Cantillon effect causes a huge wealth gap, so that the rich get richer at an incredibly fast rate. And those people who owned real goods during this Cantillon effect of money flowing out just make more and more and more as time goes on. Okay? So you want to look it up, Cantillon effect. It was a French economist named Cantillon, of course, and he was describing this effect well back 150 years ago. So it's not like it's a new thing that we just suddenly discovered. No, we've known this for quite some time. So whenever you create money out of thin air and push it into the economy, you start dealing with the Cantillon effect. So the Fed creates the money out of thin air because they don't know what else to do. Anytime we have a problem with unemployment, like COVID, they just print extra money and shove it into the economy. But the mechanism by which they do that is through the big banks. The big banks love it because they get to borrow money from the Fed essentially at 1/1000th of a percent. It's kind of like being free. They invest it in the stock market. The prices go up because of all this additional money. The inflation has to go somewhere, and right now it's going into stocks and real estate. And so all those stocks and houses are being lifted right now because of that pump of Fed money. All right. And then the price for everyone else becomes very high. So what happens is all the common people in America, they then buy these really expensive houses and these really expensive stocks and all kinds of really expensive real goods, and they go into a lot of debt to do it oftentimes. And then reality is going to come, and we'll see that in the next one.